Welcome everybody back to our next webinar of developing superb trading strategies. My name, as always, Stefan Friedrichowski. My last name very complicated, and you can address me directly with my first name. Whenever you have questions, you can send me an email to friedrichowski@argosfx.com. And by the way, thanks to Argos that we have the possibility to make those webinars just to talk about developing superb trading strategies. So that brings me already to the first important message, because there will now be a break for the next 4 weeks. Simple reason, and you see it already in yellow. I go for my yearly holidays, and I do it always the way that I have one long holiday for a year, and now it's time to go to the south. In my case, it will be Colombia for nearly 4 weeks, and therefore we have the next webinar in February at February 16. But then, by the way, same time as always. That reminds me to mention the date of today. We have the 12th of January 2017. And I hope that after that break, after my holidays, you are back here to further develop superb trading strategies. Okay, but nevertheless, if you have questions, just send me an email. The topics for today we will have a longer period now about questions and answers. It was a long debate about the walk forward methodology between one of you and me. And finally, it turns out that it is worth to do some changes, at least, in order to show or to investigate whether those changes might have a good or a bad impact on that kind of a strategy. But it was quite interesting. Was really sending around a couple of emails back and forth. And finally, we came to a point how to change maybe that kind of strategy. You will see. Then the next topic is a little bit related still to that walk forward methodology, or to a statement which came up within that method. That means, hey, do the market change, yes or no? And do we have some indications that there are changes within the market, yes or no? And I will bring a little bit light on that topic by some statistical analysis. And that is, by the way, already additionally interesting, because we can draw some conclusions out of those statistics. But you will see, it's quite interesting, I think. Then the next topic will be that we talk about swap costs. And maybe there's an opportunity, by the way. Of course, it's mentioned there are costs involved, but sometimes you can even earn money just by doing a trade. And you will see that there is an opportunity. I still don't have an exact strategy related to that, but we can use already the kind of information we have in order to improve ongoing strategies or improve your trading activities simply by taking into account those swap costs and potential earnings. And finally, I want to show a little bit about the performance of those already started Lamda strategies. A couple of weeks are now over, and I think it's a good time to have a short view on those ongoing strategies of Lamda. Good. Let's go into the topics for today. So I mentioned there was a long discussion about walk forward methodology, and in order to bring you up to date to that kind of discussion, I will repeat a little bit of last week's slides, or just only 2 slides, that everybody knows what we are talking about here. And the methodology was introduced at a certain strategy, and that strategy is called open range breakout strategies. So the basics of that kind of strategy is quite simple. You set a time frame or 2 time points within a day. In this picture here, we have midnight and 8 o'clock, and within that time we look to the price change, and we can create just that range within the 2 time points. And in this case, it's the upper line is here, and the lower end is here. You can't see really that candle. That candle goes down until down to that vertical line, the gray line. So that creates a range, and then you place 2 orders, one long, one buy stop order, so a long order on the upper side of the range, and a sell stop order, so a short trade on the lower side. And then finally, if one of those trades is filled, so the trade is opened, you cancel, you delete the other order, and you hope that if the range is left, then it will be lasting, so the price will really go into that direction of the breakout. And in my case here, we hit the take profit. Let's talk about the so-called degrees of freedom within that kind of strategy. It's the opening time of the range, the close time of the range. Then, of course, what I call the take profit multiplier. In my picture here, the take profit multiplier is simply 1. And I mentioned that there might be, or it's good to have an additional degree of freedom, which is called a minimum range. And that minimum range, is a threshold. So if the range is too small, then we would not trade that kind of scenario. Good. And what you learned is we have 4 degrees of freedom, and now we have to optimize. And the methodology here used for the open range walk forward strategy is the following. So the picture looked like this here. And we talked about that already last week, but let me shortly recap what we have done there. So what we do is we set up in the history of the data. We have here data for about 10 years of one underlying, and then we set up what I call the green box. And that green box here is the optimization box. That means within that green box, we try all possible numbers for our degrees of freedom, so entry time, close time of the range, or the opening time of the range and close time of the range, take profit multiplier, and minimum range. And then we look for a good set of parameters. Finally, when we have that good set of parameters, we apply that set of parameters to the future. In this case, I can do that because I'm far in the history of my data, and let's think that we are at the end of the green box now in terms of time, and then we can apply our good found parameters to the future. And that is really some very good point, because that trades we now investigate within the red box are not part of the optimization process. So it's a real future. They have not been part of the optimization process. So then, after having done that, so we go through the next couple of days with our set of parameters, then we simply move those windows a little bit forward, exactly by the length of the red box. And then we'll repeat simply what we have done. That means, once again, optimization within the green box, find good parameters, and then apply those parameters to the next coming future. So I repeat myself, the good thing is that we always use our parameters in the future, so which have not been part of the optimization process. The story is good in total because finally, if we are at the very end, we do nothing else in the real future. That means, look here, think about that line or the border between green and red box is really today, 12th January 2017. Then we do the optimization process within the green box, and now we apply our parameters to the real future. The good thing is that we have done the same process already 100 times and more. And if we know that we have a good strategy in the past doing exactly the same process, then why not? We should have a good strategy in the real future. So that's a basic underlying idea of this walk forward methodology, because one point is that we do exactly the same which we have done in the past without really using the complete past. And the other good thing is if we have that in general, that kind of strategy always adapts a little bit to the market situation, whatever that really means, market situation or market changes. It's automatically done by that kind of process. So the critical point within the discussion between one of you and me was now, okay, if we do that way, we lose information. So that was, let's call it a criticism of that kind of process. So that means if we are somewhere here, then we lose the information of the older history, because we have always a fixed length of history which goes into the strategy. So one remark has been, by the way, from somebody else, hey, can't we do something like an EMA on those parameters we found? In principle, a good idea. So we would not change those parameters all of a sudden, because that happens sometimes, that really the parameters change dramatically. So we would not directly use that huge changes of parameters. But the point is now, then we have a transition phase between one set of parameters and maybe a new set of parameters. And there is no good argument that this transition phase, think about the times of the range window, that transition is also good. So there's no good reason for that. So applying an EMA, some smoothing on the changing parameters, I think it's not finally a good idea. But the other idea from somebody of you has been, why not make that history longer and longer and longer? So it would mean a little bit something like the following. So we would maybe start like I do here, and let me now do the following step. So I hope still no, I have to ungroup, and now, oh, hopefully it works now. Yeah, now it works. So we have, I put that one here aside, and what we would do is, so we would start exactly like this one here, and then the next iteration step we do now would be, okay, we go here and we make the green window longer. Do the optimization process, apply in the future, good. And then once again, shift that one here and make the green, the optimization box, longer and longer and longer and longer. So finally, it would look like something like this one here. So that would mean that our used length of history data would become longer and longer and longer and longer. The good thing is that we don't lose any information of the history, and we don't lose experience out of that history. Let's call it the downside immediately is that our adaptation process of what might change within the market becomes slower and slower and slower, because think about maybe that for whatever reason the last 2 years here in that region needs complete different set of parameters. We would not really reveal that different set of parameters because we still use the complete history, but it's maybe not that bad to use the complete set of history. So honestly, talking about that, I found, hey, that might be a good idea to use that kind of methodology with an increasing optimization period within my complete historical data set. And let's simply look what are the final results. By the way, the change within my C program to do exactly the one or the other was only exactly one line of code. So it was really a minor change within the coding of the C program. Really very minor change, one line of code. But then I have to start all the things. So my computer is still busy. I'm not done with that kind of methodology. But let's have a look to some results. First of all, one result, let's start with Euro Japanese yen. That is a result out of, I have shown last week, and I will open that one as well. So now it's still loading the document. Oh, it might take some time. Let me already have a view on what else we need later, because we need an additional Excel sheet as well, and that is the result of Euro Japanese yen with that really step and forth methodology. So we need that Excel sheet as well. So that will open in a second. And now, so this is the old one. So this is the old equity line of Euro Japanese yen by this stepwise movement of the green window. And now let's turn directly to the other one, but I have to create the chart just a second, because it's really the results come in as we talk. And now we have the result with a new kind of methodology. So you see that the equity line is by far not that good. It's still slightly positive, but you see no overall good performance. There are really huge drawdowns with that kind of methodology. But anyhow, it's a result, and it's a single result for one underlying. Let me show you another result for another underlying, and that other underlying might be US dollar Japanese yen. And let's look for that equity curve as well. And now the picture changes. Now you see, okay, half of the complete period of time, so it's about until 2010. The equity is not that good, but then it's really starting quite well. So there is no direct answer to say this methodology is worse than the other one. It may depend on the underlying. It may depend on other things. I have not a clue right now. But I know that there are some underlyings with good results and some underlyings with bad results about that new methodology. For example, if I look to Euro US dollar, one which has not been part finally, because I decided that it is not good enough for the final portfolio strategy, that is Euro US dollar. And let's have a look on Euro US dollar with a new methodology. And in principle, it looks a little bit better than the other one, even if I don't compare now everything directly one-to-one, but you can believe me that this result here is better than with the other kind of methodology. So that brings me now to the question, is the methodology better or worse than this stepwise movement through the complete set of history? Final answer, I don't know exactly up to now. What I can tell you is that I have up to now, I have done the investigation of the following 16 underlyings. As you know about all kind of strategies, I not only look for the sum of profits I have accumulated over the complete history of data, I look to something else which I call the profit factor. This one should be positive and small. And let me sort, for example, the data along the profit factor. And then we will see we have sorting process doesn't work. Why not? Oh, it's P. It's P. So, and you see, up to here, we are unprofitable. So those kind of underlyings here are not profitable at all, finally. But we have, for example, good results, US dollar, Japanese yen, medium results for Brent, a little bit worse Euro, US dollar as shown, and so on and so on. So final conclusion cannot be drawn right now because I want to look to all 28 Forex pairs once again, plus Brent and gold. So there are 14 underlyings still under investigation. So I will see what the final result will be. And the other question might be, okay, let's do a selection there as well. Let's take all the positive strategies and build a portfolio. So overlap all the trades of the different underlyings and look for the final equity curve as well. And let's see, maybe that one is not that bad. I don't know up to now. Still, my thinking is that it is in principle a slightly better idea to have that process of optimization really stepwise. That means that we have one green window like that one, and that we take that specific length of history in order to find good parameters, and then we have that kind of combination, and we move both windows simultaneously like this here, and then do the stepwise optimization process and applying process in the then always coming future. Up to now, it looks like the original methodology is a little bit better than the alternative one, but let's wait for the final results. The story, by the way, I think is a little bit better for this kind one, because we have more that what I call adapting the market and potential changes within the market, even not knowing the reasons for the changes. And I don't care, by the way, about those reasons. But if we do it that with that methodology, we have always a certain history, and we look for parameters out of that history and apply those for the next coming future. But still, let's see what comes out finally. Good, so that was an alternative approach for the walk forward methodology with a fixed point in time for the optimization process and an increasing length of the optimization window or period. Good. So let's change a little bit the topic, but only a little bit. I want to talk now a little bit about observations within the markets. And what I want to have a view on is changes of so market movements within specific hours. And finally, the next step will be to have a look on the distribution of changes of an underlying. Does that follow the Gaussian distribution? Yes or no? And you might know already the answer. And the answer, by the way, is no, it does not follow the Gaussian distribution, which in principle one would expect for random behavior. We have strong deviations, and those strong deviations finally will give us a chance for our trading activities. So, principal question always behind right now is, what about, do we have overall changes within the market? And the first guess of answer might be to say, no, there are no changes within the market. And the reason could be, or the reason at least for that hypothesis, is that the basic mechanism of trading or market movements are always the same, and that already since centuries. And I only mention here two market mechanisms. And one is that the price is always built by offer and demand, and that kind of mechanism, offer and demand, is valid today, has been valid 10 years ago, and has been valid even 100 years ago. Think about this flower tulp, I don't know, I'm within the Dutch, the Netherlands, when there has been a huge increase of that kind of flower, the price of that flower. Yeah, what is the reason, or it has been the mechanism behind? Offer and demand. And therefore the price increases dramatically, and finally there was a crash for that, call it underlying, even if it has been the flower. So offer and demand is a basic mechanism of our markets, and yeah, it's valid today and it has been valid in the past. And the other one is a little bit more related to the individual market participants, and especially the private traders, I think, are strongly influenced by greed and fear. Look to maybe your own trading activities. You can find exactly those two mechanisms. Sometimes you think, hey, I want to have more out of that, and that is greed. And sometimes you get in panic and you do steps because of fear, and yeah, those kind of mechanisms have a huge impact and influence trading activities, especially of private traders. And once again, the question, why should there have been any change during the last years, even decades, about that mechanism as well? So Therefore, there might be a good reason that we don't have any changes within the market. But just an example, what about the impact of that computerized trading during the last decade? I cannot really tell you when that has been started, maybe even 20 years ago. I'm not sure, but we all know that that computerized trading, call it high frequency trading, whatever real trading strategy is behind, yeah, that has started over the last, let's say, years, or maybe the last 1 or 2 decades. And maybe that has an impact on the overall market situation or the price movements of our underlyings, which we trade as well. Or maybe there's another reason for having changes within the markets. And even now I want to guide you to interest rates. Interest rates are a topic all over. So 50 years ago, we have had interest rates as well, and we have changes of interest rates during the last 50 years. But those interest rate changes are quite slow in time. And therefore, there might be periods which have that kind of impact and periods with another kind of impact. Or another thing which definitely changes over years are changes within the industry. Globalization, for example, during the last 1, 2, 3 decades. Or maybe the demand of commodities, think about gold or oil. So there are a lot of demands, changes within the overall market or the overall economy, and those overall changes within the economy might have an impact on our prices, which we look if we want to start trades or not. So there's definitely no easy answer possible to the question, what about changes within the market? But let's do something quite practically. And I have done 2 things now. One is that I have looked for the hourly distribution of changes within a day. What do I mean? So I simply look, hey, we have, I look to H1 data, and the simple question I ask is, okay, now we have 2 o'clock a.m. and what is a typical change from 2 a.m. to 3 a.m. in percent or in absolute changes? And absolute means here that I don't look for the sign, so whether it is an up or down change. Finally, I want simply to average everything. And what I look is, hey, so do we have maybe more change in an underlying at 2 p.m. or 3 p.m. and so on and so forth. And the question I use for one kind of analysis is simply the question, at what point in time within a day do we have the biggest changes? So you might think about, okay, maybe 2 p.m. or 3 p.m. because for a lot of days we have news around that time frame. And those news have always or introduce or have an impact on price changes, and therefore those hours might be the hours with the biggest change within a day. And now we can look for that point in time, or so that hour of the day, and ask the question, is there a huge deviation within the last 10 years? And that question we can answer for different underlyings. Let me start with that kind of analysis first. And now I hope I can quickly find the right table here. Let me guide you a little bit through our data here. So first is that what you see within that chart is for the last 10 or even 12 years, for some specific hours, so 1 a.m., 5 a.m., the typical change within 1 hour. So from 1 to 2, from 5 to 6, from 9 to 10, and so on. And now we have two observations here. One is more or less related to the overall volatility. And that especially if you look around 2008, 2009, then we have the highest changes at all. The average highest changes. But that is only reflecting the overall volatility, which has been extremely high during the climax of the financial crisis. By the way, here it goes down for that kind of investigation. So already we can see that 1 o'clock seems to be a point within the day with the highest changes within a day. But I have not drawn every hour, and finally it looks a little bit different. So now I can do two kinds of analysis. One is the following. What I can in principle ask, hey, if I average everything within the last 12 years, then I can plot the typical change curve along a day. And that is this one here. And what you might already have expected, that in the morning, during the first couple of hours, there are not that high changes within the market. Then we have peaks here around 1 p.m. and 3 p.m. Within a day, maybe news-driven, and then it slows down once again until 10 p.m. And by the way, all the times are the German times here. And then there's the first up move once again to the end of the day. So that is the overall price change behavior. You might even call it a seasonal of the day, but seasonal in a sense of the distribution within a day. But now back to the question, is that peak behavior maybe a function of the date? So looking to the complete history, what I have done here, or that kind of analysis, indicates the hour with the highest change within a day versus the time, so the date of the history. And you see here, yeah, sometimes it switches from 1 to 3 o'clock p.m. and there are small periods when we have even deviations from that behavior down to 8 o'clock. So being here, that means at 8 o'clock there has been the biggest change within the day. So honestly, looking to euro US dollar, it looks more or less that there are not that huge changes in the overall market behavior. At least the highest change, the typical highest change of the price occurs always at the same hour within a day. Statistically, it's everything here is being averaged, and that is the behavior of euro US dollar. But let's look to another underlying. Let's look to euro Australian dollar. And now the picture changes dramatically. You see here that this change of the hour of the day with the highest change within the day really it's always different. Or from time to time it's 3 o'clock in the afternoon, and from time to time it's already 2 o'clock in the morning. So you see here, and a little bit more often in the last couple of years. So for that kind of forex pair, from time to time, it's totally different behavior than euro US dollar. And the potential story behind is quite obvious. I look now for euro Australian dollar, and of course, you know, Australia is about 10 hours in advance of us because of the time shift. And it seems that from time to time we have the situation that even in the morning we have the biggest changes of the price within a day. So it really looks different. And I have made one summarized picture that you see the behavior of here in total 6 different underlyings, that there are underlyings which are more or less constant, like euro, US dollar, and for example, Brent is quite stable, but there are other underlyings, for example, euro, British pound, which switch dramatically between 8 o'clock in the morning and, for example, 3 o'clock in the afternoon. And now back to the analysis of open range breakout strategy and the question, is it good that we adapt on a little bit shorter time scale to the overall market situation? This, I think, has there's a link between those two kind of analysis, because here we look to the hour of the day with the biggest change within a day, and that is something for a breakout strategy which is quite important. And if that typical hour changes within the overall history, then our strategy should adapt to exactly those kind of changes. Having in mind, for example, euro, Australian dollar, then it's maybe a good idea from time to time to have our trades already in the market at maybe 3 o'clock in the morning. And by the way, as we speak, right now we have, for that kind of sub-strategy within our open range breakout portfolio, we have quite early hours. So, and those kind of changes might be good to be taken into account within the range breakout strategy. That brings me to another topic. And the other topic, once again, I go back to my slides. The other topic is the question, is the market more random-like, or is the market, and then the consequence would be we should find a Gaussian distribution in the market movements or the hourly changes, for example, or do we have a different behavior? But now, having in mind that we have huge differences in the overall volatility, I think it's not good to really look for the change as a single number or the percentage change of an underlying. I think it's better to calculate those changes in units of ATRs, so the overall volatility. Because if I look for the changes during 2008, they have been huge. And there have been other periods in time with overall quite small changes. So therefore, in order to better map those different periods, I normalize my data to an ATR value. And then I create histograms in order to have a look on how the market behaves in general. And let's look to a result here as well. And now what we have here is the distribution of euro US dollar and already what is called a histogram. So let me, because that is row number 6 here, let me quickly, because then you know exactly what I have done. So I have looked for a couple of days in the history from that date here, from 25th of November 2005, and then I calculated that kind of histogram. So how many hour candles have been in a very tiny range, so between 0 and maybe 0.1 ATR value, and the next one here would be between 0.1 ATR values and 0.2 ATR values, and then 0.3 and 0.4. So it's simply the distribution of the changes for the last, I think, 200 days, which I have always looked for. And then I calculate that kind of histogram. And in principle, that kind of histogram should look, or the first estimate would be, it should look like a Gaussian distribution. So why not compare that distribution directly to a Gaussian distribution? And what I've done first here is that I have averaged all my lines, which means all my histograms during the last 12 years, and all the data have been normalized to the ATR value. And then we can get that blue line here. And I have already within the chart, I have done a comparison to a Gaussian distribution. So that is the red line. And you see, there's no good fit. And even if I change the widths, so the Gaussian distribution has one parameter which is called the standard deviation, and I can change that number here simply in Excel, and you can see that whatever number I take, I don't have a good fit between my data of euro, US dollar, and what is typical for a Gaussian distribution. We can even interpret what we have here. Let's say this one is the best fit. I'm not really sure, but anyhow. The main difference we have is that within the tail of that Gaussian distribution, we have higher numbers. What does it mean? That means that from time to time, the market behaves extraordinary, so to say. So it behaves stronger, stronger changes than one would expect within the Gaussian distribution. And that already gives me personally a hint of how a strategy should be shaped or should be based on. It should take into account abnormal, something which is not normal. So if we have huge deviation from the normal, then this is a hint for a good trading opportunity. And you might think already, hey, before at the end of last year, we have introduced a strategy called mean reversion, and that is some kind of exactly that strategy which is driven by huge deviations. So huge deviations should be always a good thing for trading opportunities. And we can see that within our data by looking for the distribution of the price changes. So I hope you can follow me with the concept of distributions, and whenever you have already seen a histogram, it always looks like this here, especially if it's at least close to random, but you see the big deviations within the tail, and that tail is too high in order to be random. Or in other words, there's something behind which we can use for our trading activities. That's good. So trading means trade the abnormal, so the unusual. And that should be one basic sentence for all trading strategies. Trading the unusual. And by the way, breakout is unusual, or mean reversion is unusual, and therefore those strategies have a chance to be profitable. By the way, if we look really to single dates within that kind of distribution, and I have plotted those in this graph here for different times in the history. You see the distribution itself is always quite similar. So there's no big difference, even if I'm within the financial crisis or far outside of the financial crisis. But the reason is that I have normalized all the data to an ATR value in order to make those different points in time comparable. Good. So now I can switch to another topic, but now that I think I can only do briefly, and that is something which is related to swap costs. I'm not sure whether you know all about swap costs, but and I named it already, the too short definition for swap costs is, since we trade with a leverage, we lend money, so that means we have to pay interest rates. That is maybe obvious, because if we trade one lot euro US dollar, we move 100,000 euros. So there's a leverage between our trading account and what we are doing at the market. So we lend money, and as always, if you lend money, you have to pay interest rates. That's not untypical. But that story is a little bit too short. In principle, if you we have to distinguish between long and short trades, and then the story becomes a little bit more complicated. If you think about trading stocks or indices, then it's a little bit easier normally with that kind of story, because if you enter a long trade, then you have to pay interest rates, and if you enter short trades, then normally you earn money with your short trades. For the one or other of you, it might be even a new information that you can earn money simply by opening a trade. And if the index would not change over time, the next days and weeks, then it would be indeed the case that you would earn money with that trade. But that story is only true if we have normal interest rates. If we have interest rates, so interest rates in terms of what we know from ECB or Fed, if those are close to zero, then the story is not anymore true. In this case, you have to pay for long trades as well as for short trades. And for Forex pairs, it becomes even more complicated, because now we involve different regions. For example, if we trade Australian dollar against US dollar, then we have Australia with their interest rates against United States with their interest rates. And now everything is possible. It might be that you have that you earn money with long trades. It might be that you earn money with short trades. It simply depends on the relation between the interest rates in those regions. But there's maybe a chance to take that kind of information within our trading activities. Let's first have a view on those swap costs. And what I have done here, I have collected all the data for 28 different Forex pairs, and then I went to the specifications of every underlying, and I have asked the question, would I earn money, or if so, how much? So I have always two numbers, one number for long trades and one number for short trades. Minus numbers would mean it costs me money, and plus numbers would indicate I would earn money. Where to get those numbers? Just a quick example. If you are within the MetaTrader, then you can go to, sorry, that's wrong. then you can simply do a right click on an underlying, go to specifications, and then you get those numbers, swap long and swap short. And those numbers I have collected from my table, but I have done the job yesterday. Even today there might be already some changes once again. So that's how I get those numbers. And what you can see within the table here, and I have translated, by the way, those swap numbers, which are based on BIP values and so on. It's a little bit complicated to transform or calculate those numbers in euro. I have done this within the Excel sheet. And you can see that there are a lot of Forex pairs where you can have positive swap costs, or the real way to think about that would be you earn money. So let's start with the first example here. So if you trade Australian dollar against Canadian dollar, then you earn every day that amount of money if you would trade one lot. So all numbers are based on one day and one lot. And you would have to pay nearly €5 per day if you would open a short trade. Looking to the table, one chance becomes obvious. So think about, you have a trading strategy which is really long time driven, or if you trade on a daily, weekly time frame or trade duration, then it might be a good idea to have a look to that kind of table first before you open a trade. So if you want to open a long-term trade and you want to trade euro Australian dollar, for example, then it would be definitely better if you find a short opportunity and you would not use a long opportunity. Maybe because only that reason, because you have to pay that much swap costs for that trade. So why not, if you are a trader who already looks to all those 28 Forex pairs, for example, why not use that kind of information for your trading activities? Because there are always that many trading activities, you can simply pick those with positive swap values. That gives you a bias already into the profit region. So why not use exactly that information for those long-term trading activities? So don't trade long euro New Zealand dollar. Then you can simply say, hey, I look for other opportunities. And the other story here is, and that is, by the way, a little bit of invitation for you to think about, maybe it is possible to create a more or less neutral portfolio. And I don't want to go with you now through all the numbers here and the rest of the table. A more or less neutral portfolio where you have maybe 10 trades, a couple of short, a couple of long trades, and you look for the different underlyings and the different combination of names, Australia against Canada and so on. And maybe you find something which is close to neutral at all in terms of how many long Australia you have, how many short Australia, and so on. I strongly believe that it's not finally possible to have it really market neutral, that overall set of different trades, but there might be a chance to have it close to neutral. And then it would be a very nice strategy to finally earn those swap costs, which are then earnings. So story is not at the end already, because that needs some additional investigations. But still, first information, if you are a trader for all Forex pairs, maybe you can use simply such kind of information as the swap costs for your trading activities, and you simply skip those trades which might have huge costs over days and weeks. there are maybe other and better opportunities with another underlying. So that's the one information. But the other one is, think about maybe within the next couple of days of that kind of portfolio between a set of underlyings, which finally tends to be on the swap earnings. Okay, so that's only something to think about within the next couple of days and weeks, and I will do it, by the way, within my holiday. You can be sure that's always a good time for thinking about trading strategies and what comes next. Last topic for today was that I mentioned that I want to quickly go through the performance of the already ongoing Lamda strategies, which have been started during the last couple of weeks. And those numbers are from this morning. So up to now, we have today the 12th of January 2017. We have you can find 4 different strategies at Lamda, and you can find those strategies at Argonaut. And yeah, right now that is a standing. There's one strategy in the minus, that is a so-called class trading strategy, and 3 other ones are right now plus, so have profits up to now. So anyhow, it's a typical behavior that you can't expect that everything is already huge profitable, but it's going into the right direction overall. So that's nice. And by the way, if you want, you can follow those strategies on the Argonaut platform. Wow. Yes, we have already 1 hour over. It's time for me to say, hey, those are the points where you find additional informations. You can send me emails. You can follow those strategies on the Argonaut platform. And by the way, you can download still the slides for today in the GoToWebinar control panel. You will find the slides, and if you miss any link or any information, you can simply send me an email, and I can try to help you as soon as possible. Keep in mind that the next webinar is a little bit more than in 4 weeks because of my holidays. So I will be in the warmer region called Colombia, and I expect to be safely back, and then we can go on with developing superb trading strategies in a little bit more than 4 weeks from now. So have a good time, have a good week, and hopefully I can see you back at the next webinar in 4 weeks. Very good, and thank you. Bye-bye.